The wire hits, the screen flashes more zeros than you've ever seen, and for 5 glorious seconds you feel untouchable. Then your advisor calls. After federal and state taxes, the 3.8% net investment income tax, depreciation recapture, the non-compete allocation, and a few unlovely clauses in the purchase agreement, your multi-million-dollar exit just lost a chunk. That cold rush? It's the price of selling before you understood the tax game. Let's flip the script so your exit feels like mastery, not a math quiz. Buyers purchase one of two things: your company's assets or your company's shares. That fork, asset sale versus stock sale, decides most of your tax. In an asset sale, the company sells customer lists, IP, equipment, domains, and goodwill, and you and the buyer must file the same allocation schedule that spreads the price across categories. Some slices sting. Amounts assigned to equipment can trigger depreciation, recapture at ordinary income rates. Non-competes and personal services are ordinary income too. Amounts assigned to goodwill are usually capital gain, which is kinder. In a stock sale, you sell shares. The gain is generally capital, price minus basis, without the recapture gremlins. Buyers love assets because they get a fresh basis and fewer legacy liabilities. Sellers love stock because it's simpler and tax lighter. Your negotiation tries to reconcile those desires, and elections can mimic one path while papering another, but the character of your money is ultimately set by the deal's skeleton, not the headline price. Entity choice years earlier quietly controls your closing day bill. If you are a C corporation and your shares qualify as qualified small business stock, the QSBS rules can exclude up to the greater of $10 million or 10x your original investment from federal tax if you held more than 5 years and your company met the size and activity tests at issuance. That isn't marketing fluff. It's statute. To wear that cape, you need original issuance of C Corp stock, gross assets under $50 million when issued, a qualifying active trade or business, and a clean 5-year hold, with no disqualifying redemptions around issuance. If you converted from an LLC, the QSBS holding period generally starts at the new issuance. Some states conform, some don't. Plan accordingly. If you're not QSBS, structure still matters. S-Corp and LLCs taxed as partnerships often allow buyers the basis step-up they want while avoiding corporate-level tax, but they deliver ordinary income landmines on exit, especially depreciation recapture and payments characterized as services. C-Corp allow a tidy stock sale but can suffer double taxation if the company sells assets and then liquidates. You can't fix the wrapper the week before closing. You choose it with an eye to your likely exit years in advance. Everything you receive at closing falls into 2 broad buckets: capital gain or ordinary income. Capital gain rewards patient capital and is usually taxed at lower rates. Ordinary income taxes wage-like amounts at higher rates and may bring payroll taxes. Stock proceeds are typically capital. Non-compete payments, stay-on compensation, and certain bonuses are ordinary. Equipment recapture is ordinary. Unrecaptured real estate gain can sit at 25%. Your purchase price allocation, employment agreement, and side letters set this character. Don't obsess over valuation and ignore the mix. The mix can change your net by 7 figures. Earnouts and escrows look friendly, but carry tax traps. If an earnout is truly additional stock consideration and structured that way, later payments can be capital. If it functions like pay for services, it can be ordinary. Escrows are usually treated as part of purchase price released later, capital when paid, if the documents and reporting say so. Paperwork is not decoration. It is the tax engine. Installment sales let you recognize gain as cash arrives, smoothing tax across years. They help when you value deferral, but depreciation recapture is taxed immediately and imputed interest applies. If credit risk makes you queasy, more cash now with more tax now can still be the adult choice. State taxes and residency ambush founders who try last-minute moves. High-tax states look at where you truly lived and worked, where the business was managed, where your family slept, where your home, license, and voter records sit. If you're going to relocate before a sale, break ties and build new ones well in advance. Pass-through gains are often sourced to where the business operates regardless of your new beach address. Model this early so "I moved last month" doesn't become "I owe anyway." Equity compensation can make or unmake your team's outcome. Incentive stock options can deliver long-term capital gain after exercise and holding, with alternative minimum tax risk at exercise. Non-qualified options generate ordinary income on exercise, then capital on later sale. Founders' restricted stock with a timely 83B election shifts future growth into capital gain land. Without it, income pops as stock vests. None of this is fixable at signing. Decide when valuations are low and paperwork is fresh. Depreciation recapture is where asset-heavy businesses feel the hammer. Years of deductions reduce basis. Exit allocations to those assets trigger ordinary income. If recapture is inevitable, negotiate price and allocations to compensate and steer as much as justified to goodwill. Personal goodwill sometimes applies in relationship-driven firms where the founder's personal relationships are a separable asset. If that's your story, build facts to match. Contracts that don't assign your personal goodwill to the company, evidence customers follow you, and explicit sale language. Don't improvise this, document it. The 3-year plan looks boring until it saves millions. Clean the cap table and corporate records. If QSBS is in your future, issue properly, track gross assets, avoid disqualifying redemptions at issuance, and keep board minutes immaculate. If you're an LLC and will convert to a C Corp, do it early so the 5-year QSBS clock can run. Clean IP ownership so the company clearly owns code, patents, and domains. Clean your sales tax and payroll footprint. Buyers discount or force asset deals if they smell nexus or worker misclassification. Decide your exit profile and tilt terms and incentives toward the path that fits your market. Settle state residency long before diligence. Put in place data rooms that make diligence feel like a glide, not a dig. Charitable planning can be a real lever. Donating appreciated shares to a donor-advised fund or charity before a binding sale can yield a fair market value deduction and allow the charity to sell without capital gains on its portion. The timing matters. Once a deal is effectively locked, donated shares may be treated as cash equivalents and benefits vanish. Treat this as a pre-LOI conversation, not a closing week stunt. Calendar choices can soften the bite. If you're straddling surtax thresholds or a state residency change, close in January rather than December when practical. If your buyer wants a year-end sprint, adjust withholdings and estimates to avoid penalties. Don't let underpayments nibble at your victory. Purchase agreements translate tax goals into enforceable language. If you want capital treatment, the docs must call payments purchase price and tie earnouts to business metrics rather than your personal performance. If escrow is purchase price, say so. Keep post-closing service obligations modest and separate so you don't recharacterize sale price as wages. Consider reps and warranties insurance to reduce escrow friction and keep a stock sale on track when buyers fret about unknowns. Beware of last-minute QSBS stacking schemes through a flurry of trusts created solely to multiply exclusions. Courts and the IRS can smell it. If trusts belong in your estate plan, build them early for genuine reasons. If not, don't expect applause for panic gymnastics. The 3.8% net investment income tax sits quietly on many capital gains. QSBS excluded gains are generally excluded from NIIT, which is part of QSBS's power. Gains from selling pass-through interests may or may not be subject to NIIT depending on material participation in asset tracing. Model this, rather than guessing. Consider a simple two-founder parable. Both sell for the same price to the same buyer. Founder A formed a C Corp, issued original shares at formation, stayed under $50 million in assets at issuance, held more than 5 years, and qualifies for QSBS. She sells stock. A large slice of her gain is federally tax-free, and her state conforms. Founder B formed an LLC, never planned for conversion, and sells assets. He pays ordinary tax on recapture, capital gain on goodwill, NIIT on the capital piece, and a high-tax state's cut. They both celebrate. Only one keeps the lake house and the city pied-à-terre. If you've already signed an LOI, you still have levers. Push for stock over assets if the buyer can live with it, or negotiate price to compensate for recapture and ordinary income if they insist on assets. Tighten allocation to goodwill where justified and away from non-compete in services unless you're fairly paid for those. Paper earnouts and escrows as purchase price whenever facts allow. If you trust the buyer and like the smoothing, consider installment reporting, eyes open to recapture and interest. If charitable giving is part of your plan, consult counsel immediately to see if pre-binding transfers are still feasible for a slice. Increase estimated payments to avoid penalties. And organize your data room so diligence time isn't used as a price-cutting device. Don't sell until you can answer 5 things aloud without notes. If the buyer insists on an asset deal, what's my after-tax number, including recapture and NIIT? If I can sell stock, do my shares qualify for QSBS, and for how much considering state rules? Which states can tax me based on residency and source, and have I planned that like an adult? Which parts of the price are drifting toward ordinary income, non-compete, services, earnout, and how am I steering them? And is there anything I can still do this quarter? Conversion timing, documentation cleanup, charitable transfers that improves leverage and lowers my rate before diligence hardens?